SpaceX is about to go public at a valuation of $1.8 trillion, making it the 7th biggest company in the US right now. And if you own an ETF, there's a good chance you'll eventually own a piece of it too, whether you want to or not. I've been seeing a lot of worry about this online, what it means for your index, whether ETFs are being forced to buy at an inflated price, and whether a $1.8 trillion company could throw your portfolio off balance. And I get it. When you see headlines about the largest IPO in history, it sounds scary. Not to mention that SpaceX may not be the only one. Anthropic, the company behind Claude AI, could be next at a near $1 trillion valuation. So let's get into exactly what happens to your ETF when a company like SpaceX goes public, how big its actual share in global indexes is likely to be, and why one major index provider decided not to include it just yet. If you're new here, my name is Angelo and I've been investing in low-cost ETFs for over 9 years together with my wife. Let's start by taking a quick look at what the company SpaceX actually is today, because it has changed quite a bit since most people last heard about it. Yes, they still build incredible rockets and Starlink is on its way to becoming one of the most important satellite internet businesses in the world. But earlier this year, SpaceX also acquired xAI, Elon Musk's AI company, which owns the Grok model and X, formerly known as Twitter. So when SpaceX lists on the Nasdaq under the ticker SPCX, probably around June 12th, you're not just buying the rockets and Starlink, which is already profitable, but also xAI, which is currently burning through a lot of cash, all under one ticker. Now, whether that 1.8 trillion valuation is justified or not, I'll let other people debate that. As a passive index fund investor, it's not really my place to tell you what a company is worth or whether an individual stock is worth buying or not. What I can tell you and what actually matters for your ETF is this one number. Every major global index, whether that's the MSCI World, MSCI All Country World, FTSE All World, or the selective global used by Amundi, is what's called free float weighted. That means they don't weight companies by their total valuation, they weight them by the amount of shares that are actually available for regular investors to buy and sell on the open market. Now, SpaceX is going public with 555 million shares at $135 each, raising about $75 billion. While that's still enormous and makes it the biggest IPO in history, it needs to be put into context. The entire company is valued at 1.77 trillion, which means that the shares being sold to the public represent only about 4% of the entire company. Everything else stays locked up, at least for a while. So let's do some quick calculations for your portfolio. If we take the 75 billion of investable market cap and put it into a global index, like the FTSE All World, representing around 105 trillion worth of companies as it stands, we get about 0.07%, not 2% or more, as you might expect from a $1.8 trillion company. The MSCI All Country World also covers a similar market cap currently, as does the selective GBS Global tracked by Amundi with its Prime Global ETF. Of course, its share can and likely will change over time, but SpaceX is going to make up less than 0.1% in global stock indices at its launch, which is not a reason for concern in my opinion. By the way, you can find my favorite low-cost brokers for ETFs in Europe linked down below, which is a great way to support me if you'd like to. Now let's talk about the S&P 500 specifically, because something important just happened. Earlier this year, S&P Dow Jones indices had been consulting on whether to fast-track large upcoming IPOs like SpaceX, Anthropic and OpenAI into the S&P 500. Since many other indexes chose to do that, given the size of companies we're talking about, and after all, an index is meant to represent all of the largest publicly listed companies in the market, a lot of people assumed this would happen here as well. Yet, only a few days ago, S&P Dow Jones indices officially decided against it. Their statement was actually quite clear. Exceptions to the profitability, seasoning, so at least 12 months of public trading, and free float requirements will not be granted regardless of how large the company is. So what does this mean in practice? SpaceX cannot enter the S&P 500 until at least mid-2027, and only if it can show 4 consecutive quarters of positive earnings by then, which is far from guaranteed given the company is currently losing money. This is actually quite substantial, as the S&P 500 is by far the most tracked index in the world, with around $13 trillion in assets following it. So in case you're currently invested in an S&P 500 ETF, the answer is simple. It doesn't look like you'll be holding SpaceX or another mega IPO this year and likely not next year either. Whether that's good or bad is for you to decide. Now briefly, what about the tech-heavy Nasdaq 100 index? Nasdaq actually rewrote the rules earlier this year specifically for situations like this. Any company large enough to rank among the top 40 Nasdaq 100 members can now be added after only 15 days of public trading. This means SpaceX would enter the Nasdaq 100 index around early July. Not only that, Nasdaq introduced a specific rule for low float stocks. They get weighted at up to 3 times their free float market cap. Basically, SpaceX gets treated as if roughly 12% of the company's stock is available instead of the 4% that actually are at its IPO. As a result, its share in the Nasdaq 100 is likely to sit somewhere between 0.5 to 1% of the index when it's added. So if you hold a Nasdaq 100 ETF, you'll actually become a shareholder around the same time or even slightly after most global ETF investors, but with a larger position. But even here, we're not talking about a portfolio defining allocation. Now, are ETFs really forced buyers? Let's try to address this fear directly. The idea that index funds are forced to buy SpaceX at whatever price it's trading at, and that this could hurt you and me as passive index investors. But the reality is, even if SpaceX drops 50% shortly after being added to your global ETF, your portfolio moves by about 0.035%. That's less of a move than what we tend to see on a quiet Tuesday. At less than 0.1% in a massive global index covering thousands of stocks, no single company, even a 1.8 trillion one, can define your outcome. And we've seen this play out before. When Tesla was about to enter the S&P 500 in December 2020, there was widespread fear about forced buying at an inflated valuation. People were worried their index fund was about to get hurt, but the index kept going and long-term investors who stayed the course were just fine. Now, as I mentioned at the start, SpaceX isn't the only mega IPO that's coming. Anthropic, the company behind Claude AI, which I also like to use on occasion, filed its own confidential IPO paperwork with the SEC a few days ago with a current valuation of close to $1 trillion. And OpenAI, the company behind ChatGPT, is expected to follow later this year. The likely ETF impact is the same story, as the initial index exposure will be tiny due to the small free float at launch. But here's the bigger picture. These 3 companies together could bring well over $3 trillion in market cap to public markets within months of each other. Index providers have clearly seen this coming, which is exactly why most of them updated the rules over the past few months. Not to force ETFs into buying at any price, but to phase in exposure in a controlled way tied to what's actually available to trade, and to reflect the largest publicly listed companies in the market as closely as possible. As for buying SpaceX as an individual stock, you can find it on the US Nasdaq exchange from June 12th under the ticker SPCX. I won't be doing that. But if you're curious, a European broker with direct Nasdaq access, like Interactive Brokers, which is what my wife and I use for our ETF investing, would be one place to look. So that's the full picture. We have a $1.8 trillion IPO that will likely only make up around 0.07% of your global ETF. An S&P 500 index that's holding firm on its rules regarding time in public markets and profitability, and a wave of mega IPOs that index providers have clearly been preparing for. I'm sure that the scary headlines regarding massive valuations will keep coming. First about Anthropic, then probably OpenAI, and maybe others after that. But the index investing mechanics don't change. Free float is free float. If you're a long-term ETF investor, none of this requires you to change anything. The market consists of thousands of stocks, all competing with each other and going up and down in value at different times. You'll always have new companies joining and other companies leaving the index. Only time will be able to tell if the new mega IPOs are overvalued, undervalued, or priced just right. My wife and I will happily sit back, relax, and let the market decide it for us, just as we've done over the past 9 years as passive low-cost ETF investors. Hopefully I was able to help you put things into perspective a bit with this video. Now I'd love to know in the comments, is this wave of trillion-dollar IPOs something you're concerned about? Or are you looking forward to some of these companies going public? You can find my favorite low-cost brokers for stocks and ETFs in Europe linked down below, which is a great way to support me if you'd like to. Apart from gently tapping the like button and subscribing, of course, if you haven't yet. As always, none of what I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful day, and until next time.